and I had the misfortune of seeing many investors saying I'm done with equities and I'm going out of equities. And it was very depressing for me to see they went out of equities at the wrong time. If I had realized it in 1994, I would have been definitely better off. What I have seen in my stockbroking days is anyone who says I will do everything abruptly, that person is normally a loser. It is only when a SIP happens through a bear market that an investor actually gets the best return expectation.
I want to know some bit of your personal life in terms of your best book, best fund manager. Whom do you yourself, if at all there is someone whom you look up to in terms of either peers? Hello everyone, welcome to our latest episode of Money Confessions from GoalTeller. We've had quite a lot of financial experts ranging from Nitin Kamath to Rajiv Thakkar, Nilesh Shah. But today we are joined with Mr. S. Naren, who arguably is one of the best fund managers in the country and surely on the value side, one of the best names globally. And welcome Mr. Naren, it's an absolute privilege to have you with us. I think your learnings and views on equities, on markets in general, investing in general, asset allocation, I'm sure will be extremely helpful to all our viewers and listeners. Thank you once again and welcome to the show.
Welcome. Nice to talk to your viewers.
Yes, thank you, sir. So what I would like to start with is maybe a very quick, 2-minute brief about yourself and your investment philosophies and anything which you would like yourself to be known as.
No, basically I was lucky to have got into equities and investments fairly early back then in Chennai in 90s. So I believe that you should get into the right industry at the right time. And so I would say that clearly helped. And again, I was happy to be part of ICICI mutual fund from 2004, just when the mutual fund industry actually grew substantially. So we got the chance to be involved in managing other people's money from 2004 onwards. Investing is a very interesting industry, provided you get things reasonably right. And it is an extremely stressful and pitiable industry if you get it wrong. And I believe that the biggest advantage that people in my generation have is that we have seen the 90s. And many of the people who are part of the industry today have the disadvantage of not having seen the 90s. And that I believe is a big advantage, particularly when you're managing other people's money.
Right. So, now coming one specific statement you shared about the 90s, don't you think it is very worrying that forget the 90s, people have not even seen 2008, most of the investors, especially the Robinhood investors or the new age discount broking investors who have come into the market?
Absolutely. I think that is a very, very big handicap that I notice at this point of time, that most of the investors who are in equity markets have not seen 2008. In fact, if you look at the entire set of investors, there is a set of investors who were there prior to 1994. Then there's a set of investors who were there prior to 2008. Then you have this set of investors today. And I really worry, there is only a set of small investors like us who have been there right through. And, the challenge is, you should have seen these cycles and crossed these cycles. And it is only the investors who crossed these cycles who really benefited out of the markets. The people who dropped out of equity markets in 97, 98, they are all people who did not benefit. Similarly, the people who dropped out of equity markets after 2008, they have not benefited out of equity markets. So it's very important to transcend these cycles, and that is the challenge for investors. And that is the biggest important lesson that I would say that investors need, because I was a stockbroker between 94 and 2004. And I had the misfortune of seeing many investors saying, I'm done with equities and I'm going out of equities. equities. And it was very depressing for me to see they went out of equities at the wrong time. And that was the very, very painful thing for me to watch. Whereas people like me who have been part of markets for the last 33 years are the people who have seen the benefits of the markets and not the people who dropped out after one bull market.
Absolutely. I myself come from a stockbroking background. I've been in the market since 1996. So it surely is helpful to have seen a lot of market cycles. Sir, now coming to the other point is that you have you are a man of very low words or less words, and we don't see you in the media very often. When people typically want to know about equities, about investing, you are the person to go to, and you have been one of the few people who actually stuck as in a mutual fund house for 2 decades now. And what's your view of what are the mistakes that investors make, view on asset allocation, and what's the holy grail of investment that you would advise everyone?
Actually, what I believe very strongly now after being part of markets is that one should not every day come and over communicate. And in my opinion, there is only one thing that people can over communicate on a daily basis, that is asset allocation. So if you over communicate every day about markets, it will not work. It will be like every day saying that there is a lion next door, be careful. Then actually the day there is a lion, it will not work. So I believe there are times when you have to over communicate to the market participants, and there are times when you should not over communicate. And the only thing you can over communicate is asset allocation. And this is the learning, because if you see in the year 1997 is the first year I realized that you have to do asset allocation. I didn't realize it in 1994. If I had realized it in 1994, I would have been definitely better off. But in 1997, I realized that you have to do asset allocation, and or rather not be over leveraged in equities. I would put it the other way. So again, if you look at what mutual funds did in the 2004 to 8 cycle, they thought of themselves as equity mutual fund industry. And that hurt them between 2008 and 2013. So one of the biggest things that ICICI Prudential did was that we saw ourselves as an asset allocation company than an equity mutual fund company. And once we started to see ourselves as an asset allocation company, what we realized was that we are in a much better shape, because what happens is that you are there all the time. So in periods like 2020, we could actually invest very aggressively because we had collected money in strategies like balanced advantage and asset allocator fund of fund, which allowed us to invest in March 2020. So the basic learning is very simple. You have different asset classes. You have one asset class called equity, another asset class called debt, a third asset class called gold, a fourth asset class called real estate, a fifth asset class called international equities. So if you look at it, even within equities, you can have different types of equities. But what happens is, there are times, when you can actually pull out money from one asset class and put it in another asset class. You go back to 2007, gold was a asset class which has done very badly. You could have put money in gold. In 2013, if you look at it, real estate had done well for a decade. It was a simple task to take out money from real estate and put it in equities. So at heart, what is asset allocation is taking money from an asset class which has done very well and putting money in an asset class which has done very badly. And if you're capable of doing that, on your own, without any mutual fund, without any wealth manager, without anybody else, you're going to make incredible money in your life. And if you do it through the use of mutual funds, it's very good. But if you can do it on your own, it's very great. Because in 2013, I used to go to Delhi and tell people you have to sell all your real estate and put it in equities. And I almost got booed in Delhi. Because at that point of time, people were buying under construction projects which would come up in 2020, in 2013. And what happened to Delhi real estate market. So I believe, there are times, when people don't realize that a winning asset class for the last decade is actually an asset class which is more risky. And last year in October, most of the global equities had done so badly relative to India. And it was such a simple task for me to tell people you have to invest globally in equities at this point of time through all the global funds which are open at that point of time. It was very big task for anyone to invest at that point of time, because at that point of time, Taiwan had done badly, Japan had done badly, China had done badly, Nasdaq had done badly. So the task of asset allocation is very simple. Just invest in a very big losing asset class and take out money from a winning asset class. That is asset allocation. And if you can do that, you're going to make huge money. Imagine in 1994, you took out money from equity. You would have actually made huge money. Imagine at the height of Harshad Mehta, you took out huge money. You would have made huge money by taking out money in equity. In 1993, markets crashed. If you had put money in equity when markets had crashed, you would have again made huge money. In 2003, for one decade, equity had done badly. Just imagine you had put huge money in equity in 2002-3 when equities had done badly for one decade. Imagine what returns you would have made. So I believe it's simple. Asset allocation is very simple. Asset allocation is not like doing stock picking. You don't need big knowledge. You only need logic. And you need common sense and you need temperament. And if you have logic, common sense and temperament, you can make huge money. And the whole world will tell you, you need to know this, you need to know that, etc. If you go back to 2012, gold had done very well for 5 full years. So tell people on that year that you have to take out money from gold. It would have been a tough task, but that year, if you had taken out money from gold, you would have been a winner. So this is the simple thing. So what we did at ICICI Prudential is popularize asset allocation orientation through multi-asset category, balanced advantage category, etc. And I believe that is the other way of doing it. But I don't think it needs to be done only through mutual funds. It can be done through the direct route also. And you can do it through the multi-asset category or the balanced advantage category. You can do it directly. In either way, I think if you do asset allocation, you will be a winner. You'll be in the top 10% of all investors in the world. And that is the view I have at this point of time, having seen markets for 33 years. But remember, you will be doing always opposite to the market, which means that in 2020 March, you'll be investing in equities. In 2021 October, November, you'll be taking out money from equities. In 2017, you'll be taking money out from small and mid cap. You will be much more cautious today on equities than you were, let's say, 1 year back. So I believe that you would be doing things which are exactly opposite of what bulk of the people are doing. And that is not easy. It will appear to be easy, but you will have to shut out what you read in media. You will have to shut out what others are doing. Then you can make money. And that is the challenge of investing, that you can do asset allocation, but asset allocation is being inverse of the market somewhere. And that's very, very easy to make money, but very, very tough to implement.
So, 2-3 things here that I wanted to ask. So, what you've said, would it mean to take radical calls on asset classes? Like, what would you suggest if a retail investor is there and let's say he has a 50-50 equity and debt allocation? And in case if markets are extremely or look very euphoric to the individual, shall he make it zero or shall he move into a zone? That is the first question. Second question is that, the person should be willing to look like a fool for months at times, because you exited and then you see the markets continue to go up. So that requires a lot of emotional resilience. So what would you advise people on the second element? So these are the 2 questions I have on what you mentioned.
See, what we learned over a period of time, and is that do everything gradually. Don't do anything one shot. Don't decide that any level in the market is the top of the market. So do it gradually. And what I have seen in my stockbroking days is anyone who says, I will do everything abruptly, that person is normally a loser, either on the buying side or on the selling side. Do everything gradually. So if you decide that you want to go to cash, don't do it on one day. So as the market goes up, gradually from here, you keep selling. Then you are much more comfortable. Then you don't panic if the market goes up. So that was hard. That was at the heart of the strategies that we used in our balanced advantage fund, that everything will be gradual and never done on one day. And I believe that you have to do it gradually. That also reduces the pain that you go through, which happens to you if you do it on one day. So if you decide, let's assume that at 20,000 Nifty, I will go to zero in equity, then your pain is very acute. Do everything gradually. Do the process of investing gradually. Do the process of disinvesting gradually. That is where I believe that, real estate can be a bit of a problem, because you can't do real estate investment gradually. But there also, I believe slowly what will happen is, today you have office REITs. So you can invest in office space gradually. You've got malls which are in the form of REIT. That also you can do gradually. Only you don't have residential REITs at this point of time. So other than residential real estate, almost everything in the market today you can do gradually. And the moment you do things gradually, which is what many of the strategies that we run also do gradually, you're in much better shape. The moment you do it on one day, then I think you feel you're lost, you've missed the bull market, you've been too early in a bear market. All these kind of questions come and it destroys your entire mood. So do everything gradually, and you can do everything everywhere except in residential real estate.
Right. So any floor or cap to be kept here, and have you people done it in the balance advantage fund, in the sense that are there any levels that you feel are sacrosanct that you will not breach on the downside and the upside, come what may, however attractive it is or however de-attractive it is?
See, in the old scheme information document, we had a floor of 30 and a cap of 80. In the new scheme information document, we don't have these floors, but so far we have not yet ever breached these two floors and caps. So the floor has been 30 and the cap has been 80. And we have not ever breached this floor and cap so far. Although right now the scheme information document does allow us to go beyond these floor and caps. Because the old document forced us to these floors and caps, we've still retained the floors and caps in the way we have run the strategy so far, but we are not capped by it.
Understood. So for a retail investor, of course, it might not be wise to take very, very radical steps, as you said. Secondly, I think doing it themselves also run its risk, because it is very, very human for individuals. And since we manage a lot of retail investors, we see, forget retail investors, even HNIs, they only are in the term HNI, but the mentality is mostly the same everywhere. To exit in euphoria and enter in panic, I think very difficult, easier said than done.
But if you do it, you'll make huge money. Frankly, if the goal of Money Confessions is to make investors a lot of money, then there is no choice but to do it.
Yes. So in our, sorry to digress, but we ourselves in 2022, in our Diwali newsletter, had been mentioning Nasdaq as a big buy. And we had mentioned that the Nifty should be touching 20,000. And thankfully, some people did invest, and they are sitting on almost 25-30% of absolute gains on Nasdaq itself. Unfortunately, now there is only one fund which is left, which is taking money, which is Invesco Nasdaq. And now since April, the taxation has also become inferior. So it's a little unfortunate, but I take your point. I think that's a very good suggestion. And let me be honest with you, very few people have the guts to give this kind of a suggestion on a public forum, because people generally, most advisors, including ourselves, we play a little bit of a mid ground, where we say have some bit of a floor and cap which you don't breach irrespective of what happens. So I think this is extremely good advice that you've given. And would you also suggest that individuals within asset allocation, they do asset allocation of sub-asset classes, like how much should be maximum exposure to gold, to mid-cap, small caps, to international equities, as you rightly said? Is there a number that you would guide in with your experience of the Balance Advantage Fund, or your own investor beliefs?
See, I think as investors become more sophisticated, and as investors start to have larger portfolios, and as they have the ability to take bigger risks, you can do all these things in a bigger way. And I believe that it is a function of that, frankly. So I believe that it should come from them. The problem is that if an investor has not seen even 2020 March, so I think I would advocate a much more cautious strategy. A person who has seen 2008 and has been an investor before 2008, that person, and I would advocate a much more aggressive strategy, because that person has seen much more. A person who has seen 90s and has stayed as being an investor, I can advocate much more. Person who has seen 99, 2000, 2001, I would advocate much more. So it's a function. What I believe is the model which exists today, that an investor directly enters to trading options, is what worries me at this point of time. I believe that, it kind of worries me what I see in the market in terms of volumes of options being traded, kind of worries me, because at the end of the day, I think the right model would not be that they start trading options. And that's something which kind of worries me, because I have seen this 89 to 94 phase where the retail participation in equity was high. And we kind of feel very happy with retail participation in equity. Always when you have retail participation in equity, the retail participation in equity is not a good sign unless it is done nicely. I say the positive about the fact that retail participation in SIP is a positive, and that is clearly a positive over retail participation in lump sum. So I think that is a positive, but even a SIP in the near term, I hope investors realize, is not an activity which leads to positive returns. It is only when a SIP happens through a bear market that an investor actually gets the best return expectation. And I hope investors who do SIPs realize that a SIP through a bear market is the best investment that they can ever make. I hope they know that a SIP in a bull market is not equal to SIP in a bear market. And they need to actually do that SIP in a bear market to get the full benefit of the SIP. And I don't know whether they understand that, but
no, they don't.
The fact that they are SIP oriented is very positive for me.
No, but they don't know, sir. I mean, I can tell you, 3 months back when the Nifty was around, almost less than 17,000. Last year when it was 15,500, 16,000, when there was all this crisis, semiconductor, the war and all that, people came to us and asked that, you guys have made us start the SIP. Shall we stop it right now and start it back? I told them that this is the time when you're averaging down. Otherwise, you've been averaging up. And I think this is a very good thing that you have said. I think the terminology is very good, that SIPs in bear market do well, much better than SIPs in bull market. So this is extremely golden advice that you've given. Now, Mr. Naren, what I wanted to ask also is, for people who are doing long-term investing, who do not have the time to possibly time the asset allocation, let's presume, in such cases, would you suggest them to just buy and hold, or maybe invest into something like a balanced advantage fund, which gives them the higher return?
I think buy and hold works very well. I believe SIPs work very well. But every day they cannot look at they should really not have time. The biggest problem is that people who don't have time find time to look at their portfolios too often in this age. That is my biggest worry. So, genuinely they should be long term and they should be buy and hold and not look at their SIPs. They should invest in their SIPs, see through a market cycle, and then look at what happened to their SIPs after the market cycle. So, I've been involved in value discovery initially and recently. If you take the 19-year experience of value discovery, it went through two bouts of 3 years, 2006, 7, 8 and 16, 17, 18, where the fund did badly. But if you look at the 19-year experience, it was good. But out of that period, there were two phases of 3 years where you could have looked at it and said, why is this fund doing badly? And that was the interesting thing, that now, because we have an history of 18 to 19 years of that fund, it is easy for us to explain that there have been two bouts of 3 years when the fund has done badly, but the 18.5-year experience has been good. So if investors invest in that fund and start looking every 3 months, because they have every Saturday, Sunday mandate to look at their portfolio. In 2018, there are people who have redeemed because they have looked at their portfolio for the last 2 years. But if you go and today look in 2023 on their investment in 2016, it has been pleasant. But the challenge is that unfortunately in this new area where, it's so easy for people to see their value of portfolios any Saturday or any Sunday and such, India has some of the best IT professionals. So for them to see their portfolio value every minute is so easy. It has created the problem that they are able to see. Whereas if you look at real estate, the fact that no one knows the value of the real estate that they invested has ensured that they stay invested.
And so, sir, this I would like to draw your attention to one more concept is like reversion to mean. So I have been watching two funds very closely. One is ICICI Value Discovery and the other is HDFC FlexiCap Fund. I think they've had similar journeys, especially in the last 7-8 years. And, till 2016, 17, 18, as you rightly said, till 2018 especially, both these funds were not doing well. But suddenly 2019, 20, post-COVID, after the revival of PSU banks, etc., I think these two funds were one of the best performers. So two questions here. One is it reversion to mean that you are talking about? Secondly, between value and growth investing, which is that you prefer? Of course, you are a very well-known advocate of value investing, but from a layman investor perspective, what is that you would suggest?
See, as an AMC, we have both styles. We have growth style, we have value style, we have quality style, we have everything. As a fund manager, I'm a value style or a special situation style investor. So I believe that as an AMC, we can't say we are only value style. Because any style, like Value Discovery went through a 3-year period. 2021 and 22 was very bad for quality as a style. And so I believe that you cannot, as an AMC, when you're managing such large sums of money for other people, you have to have all styles. So we are believers in all styles when we run an AMC. Personally, I'm a value-oriented or a special situation. These are the two styles which appeal to me. And the difference between these two styles is when you're doing a growth style, you have to actually do the right work. And research has to be much, much more perfect. So if I take a stock like NVIDIA, which luckily we don't have to look at. Look at the market cap of NVIDIA based on artificial intelligence chips. You have to do the right work. If it turns out that the NVIDIA chip is not suited for artificial intelligence, that stock can go down 80%. Whereas many of the stocks that I own in my value fund, many of those stocks trade at 3 PE and 4 PE, some of them trade. So I'm paying for 4 years earnings. Whereas some of the growth stocks, you're paying for 70 years of earnings or earnings which come after 5 years, and that earnings is trading at 50 times earnings. So the quality of research that is required in a growth style investing is much, much higher than what you need to do in a value style. So that's how we see it. So internally in our AMC, we tell that the growth style research has to be of a much, much better quality within the company. Whereas in a value style, you have to be very careful that you're not bought a value trap. You're not bought a company which, let's say, makes a landline phone or something like that, or makes horse carts or something like that, which will just go into oblivion. That is what we have to gather and not make a mistake in value style.
Right. So, and of course, some studies have also shown that the value style of investing needs much more patience than the growth style, while the growth style needs much more agility. As you rightly said, if the current trend is, doesn't sustain, then one could go big time wrong, which is not in the case in value. And thirdly, another school of thought which is said that if the market multiple is low, there is possibly a reason for that. So what would you comment on these three for a retail investor that, of course, from a downside protection, value is possibly better, but shall he go with a diversified equity fund which essentially takes these calls on his or her behalf, or shall he try to stick to a specific style of investing depending on his emotional quotient?
So we move to a situation where you have to be partly contrarian. That too, when we are managing large sums of money of other people. If we are contrarian, it helps us a lot because we are able to buy large sums of stocks. So if quality goes into out of favor, we are able to buy quality. If growth goes out of favor, we can buy growth. So from a mutual fund point of view, we believe that a contrarian style helps us to manage large sums of money for other people. And that we have found it much more useful. What an investor wants to do is I believe asset allocation is the way to go. And I believe that asset allocation works the best in most markets, particularly when markets are not cheap like today.
Right.
When markets have a crash or something like that, it's very different. In those markets, I believe that you have to take risks. And those markets, when you have those crashes, they will happen. Suddenly something will happen and you will get that opportunity. At that point of time, do you have the ability to take those risks or not is the interesting thing, like NASDAQ last year, as you pointed out. So those kind of situation is what would be very interesting. Whether people have the guts to take that call when everything seems to be negative. Otherwise, for most periods of time, an asset allocation kind of approach serves the need for making very good money most of the time. And you'll be surprised that it works so well most of the time, except when markets are very cheap or there's a serious problem, like post-Lehman, let's say just after the Ukraine war, or just after World Trade Center Bombay, just after Demon, just after some serious crisis has happened anywhere in the world, like in China in 2015-16. So those periods of time are the times when you gather the guts and take risk. In all other periods, asset allocation itself works. Why do you want to do something?
But so one question, few questions on the business that you run. So, in my, again, 2.5 decades of experience, I have seen funds pandering to the investors in terms of how do you manage to stick to your conviction? So I have seen value discovery, you stuck to your conviction despite the fact that you lost very valuable assets, in that fund. As you rightly said earlier, that you saw redemptions. How do you convince your sales teams or the market that no, I will stick to my conviction and this will pay off? At times, do you feel that you feel naive at times that I should also be doing what others do and just try to treat this as an asset gathering machine? What do you feel about this?
I have to thank ICICI, my organization, for it more than anybody. Otherwise, my bosses, my organization, those are the people who are responsible for ensuring that we could maintain a certain process and stable. See, we've seen that even in credit, which is a very different kind of asset class. There was a time when people took credit risk which should not be taken, and that led to returns in the near term, which was higher, but we knew that return would not stay. It took again 3-4 years to play out, but at the end of it, there was mayhem. So what happens in investing is there are times when the near term can be bad or good. In this case, it was good that you got extra returns. But, at the end, finally rationality wins. That's why Benjamin Graham says, in the near term, investing is a voting machine. In the long term, it is a weighing machine. So, we finally at ICICI, we believe it's a weighing machine. So, and we are not managing large sums of money. At this point of time, we are managing 5,50,000 crores. When we are managing 5,50,000 crores of other people's money, there's no point in trying to do something which will hurt 5,50,000 crores. It's much better for us to take short-term pain, because what we will compromise is 5,50,000 crores. For the sake of short-term, we can't do something which compromises 5,50,000 crores.
Right, sir. So one more thing I wanted to ask is, a lot of funds have these, again on the asset allocation side, people try to get in when markets go up and, vice versa. In fact, instead of reversion to mean, they go where the mean is for them. So some funds have done this study about the funds returns being 18-20%, which is always shown. But most investors come and ask us, I have not seen anyone who has made this return over 15-20 years. And of course, the reason lies in, I guess, people moving in and out. So any light that you can throw on this in terms of any study that ICICI has undertaken?
So ICICI hasn't undertaken any study, but the general investor experience is worse than the actual return experience. And this is something which is seen across the world. And that's one of the reasons why index funds took off. Because people always come into the funds after too much of performance. And then they don't get the performance. Then they blame what happened. So that's how index funds took off across the world. So that's the challenge of investing, that can you invest after bad performance?
No.
So that's why we changed the whole model and said, forget about anything, look at asset allocation and choose categories like balanced advantage or multi-asset, because there, it is much more like, what the banks and insurance companies have taught the mutual fund industry is, they don't go and talk. Does the insurance industry talk about performance any day? They don't talk about insurance performance, but they keep getting money. If you look at it, the banks sometimes which offer the lowest fixed deposit rate get the highest money. So they don't talk about performance. Why does the mutual fund industry focus on performance? So that's why we also inverted it as an asset management company and said, let's focus on asset allocation, where you're not going to get the highest return. The highest return sometimes comes in infrastructure funds, comes in technology funds, comes in banking funds, comes in pharma fund, it comes in technology funds, it comes in all kinds of categories, small cap funds. But finally, at the end of the day, performances are mean reverting. Whereas if you invest in asset allocation based strategies, you are never investing in the highest performing funds. So that's how we inverted it actually.
And Naren, one more thing which I wanted to ask you is that size. So you have been managing balanced advantage fund, right? And I think the performance has not shown any signs of impact due to size. But there are funds which we have seen that beyond a certain size. I will not be able to comment whether it is correlation is causation here, but there is a correlation of size that we have witnessed in certain funds where they go beyond 20, 25, 30,000 crores, returns start dipping. Do you see this a challenge at all?
No, I think the challenge in balanced advantage fund is lack of market volatility. If markets go up one way or go down one way, that is a problem. It's not a question of scale, because otherwise we operate against the market. So we don't like one-way market going up or one-way market going down. That's the only challenge. In all other funds, the challenge is sometimes scale, because end of the day, you are how to manage scale does become a challenge. In balanced advantage fund, we want market volatility. So if you don't have market volatility, that is the challenge. So we want US yields to suddenly shoot up. We want US yields to suddenly come down. We want all these kind of market volatility events. We want crude oil to suddenly go up. We want crude oil to suddenly come down. These kind of volatility events give us scope for us to make money. The scale of the fund is not the problem. The lack of market volatility is the problem.
Interesting. I'll keep this in mind next time when any investor tells us that which fund to invest if there is trouble.
Yeah, exactly.
So, sir, now coming to, you are doing a great fiduciary duty of managing such a large corpus and doing it so well. But what was your first investment, your best worst investment, if you could share personally and from a fund perspective also, as you look back in history?
See, the first personal investment I made was a company called Lakshmi Vision Works way back in 1989. And it turned out to be a multi-bagger and gave me the confidence that I have to make equity my profession for my career. So I think it was an experience that I'll never forget.
And do you still hold it?
No, I don't. I don't, but I'm, if something is responsible for your career, you don't forget it.
Yeah.
And actually, it'd be interesting that, I used to run the infrastructure fund, and at that point of time, and since we are talking about a stock long back, we did make a lot of money in Jindal Steel and Power re-rating in the 2004 to 7 cycle. And that's when I realized that, commodity stocks can get re-rated very significantly in a bull run. And that was a very interesting investment for me in the 2004 to 7 cycle in the fund, infrastructure fund, which I used to manage.
And your worst investment that you have done, like any learning from?
Yeah, what we learned over a period of time is that, we've invested in Discovery Balarpur in 2004. If I, at some point of time, we booked a loss, but if we had held it from 2004 to 2023, we would have lost all the money we made. That's when we realized there are sectors which don't create shareholder value. And some stocks also don't create shareholder value, which is why in value discovery, we always do a check, are we investing in a value trap, because that is very important, because you can buy a stock cheap but you have to know whether you're investing in a value trap or not, and that is something me and my colleagues at ICICI keep discussing that.
Any checklist that you follow, or in the sense for ensuring that, of course, you can never say never, but some basic rules, philosophies that these are the things I look for when investing into a company or a sector or theme?
We do based on cycle, ownership, valuation, earnings revision, and at the time we are buying, we look at technicals. So we look at all these factors broadly when we are doing in a category like value. When we are in growth style investing, of course, we have to look at different things, whether the category itself is growing, whether the growth is likely to come or not. So it would depend also on the style. So broadly, we have to keep refining many of these checklists over time, and that has actually helped us, because when you're running a small fund versus a large fund, also we have to keep refining these checklists.
Any one or two just like really fundamental checklists that you have in mind, like pointers, like avoiding debt companies or anything like this, or not really? It depends on the time.
Yeah, I think basically if you can understand where the cycle is in that industry, we have found it to be very useful. If you have a judgment of cycle in that industry, so if you think that the cycle in this industry is headed downwards, we've seen that whatever a company does, it doesn't work, and you lose money in that industry. On the other hand, you can buy the worst stock in a sector which is going up, and you tend to make money. And this is what we have seen. So we've seen that cycle works very, very well. If you're able to assess the cycle in an industry, it works very, very well.
And so, one question which we keep getting, you might have answered this earlier, asset allocation thing, is timing. So people come and ask us, whether shall we invest in one shot, shall we stagger the deployment? If you've got a pot of money, SIPs, of course, is through the regular cash flow the person gets or the individual gets. What if someone gets a pot of gold through a bonus, annual bonus, sale of property or something? How he should deploy that? Should he, of course, studies have suggested that, one-time investment generally is better. Timing is not correct. But what would you advise to such individuals?
See, broadly, we believe in asset allocation. But suppose you get your asset, if you get your bonus on March 2020, it has to be more equity oriented. If you get your bonus in September 2007, it has to be gold oriented or debt oriented. So it also depends on where you're getting the lump sum and what is the asset, what is the valuation of different assets at that point of time.
And any metrics?
Broadly, I'm a believer in timing of entry on valuation.
Okay.
So, if, for example, last year in September, October, if you suddenly got a pot of money, it made sense to invest in international stocks. So that's how we look at it. But otherwise, broadly, it is asset.
But what would be the metric, like price multiple or the downside from the top? Anything for a retail investor to understand whether it is down or high?
It is past returns and valuation I found useful. If some asset class is done very badly,
okay,
I view it very, very positively. So if real estate in 2020 had 7 years of no return, so even a person like me who used to dislike it, I tried telling people now it's become a great asset class because you've had 7 years of no return. So somewhere, if you're caught confused, I would say bad past returns is a very, very positive sign. And very high past returns is a very...
And what periods in this would you suggest, like 1 year, 3 year, 5 years, like in 3 months if the market has gone up 20%, let's say in today's situation that we see the market has jumped up after being in a zone for at least a year and a half. So shall the person see the last 3 months return that it's gone up, or if he sees the last 2 years, he might not see it gone up so much. So how does he decide that?
I would use a combo of 1, 3, 5 and 10 years rather than 3 months.
Okay.
I leave the 3 month to the fund manager, and I would actually, as an investor, I would look at 1 year, 3 year, 5 year, 10 year.
Okay. And what's the mean here that you would look at? Like let's say, since we are talking reversion to mean, so would you take, let's say, 12% as a mean, and in case if returns are 8%, you would think it is attractive. If it is 16%, you might think it is unattractive. Is something like this?
I actually compare everything against bank FD rate. So that's how I compare. Suppose, let's say bank FD rate is 7-8%. And your 10-year return is 0. So I feel very comfortable. On the other hand, a bank FD rate is 7 and 10-year return is 15%. Slightly worrying, if you ask me. So I agree equity should deliver a better return than bank FD rate. But if the gap is very large, I would worry. Obviously, you should get better return than bank FD. But 7 is bank FD. Let's assume you get 3-4% more. 10 is okay. Yeah. But if you've got 15 in the last 10 years, then I really worry. So for me, past returns I found to be very, very useful. And so you take a combination. Don't take 3 months. Take 1 year, 3 year, 5 year, 10 year.
Right.
And you'll find that it works. It has not worked only in Japan and recently in China. But barring that, it has worked almost everywhere else.
Right. So now, sir, coming to a few things in terms of any structural trends that you see in terms of technology, or any trends that you see over the next 5-10 years, not in terms of stock markets as such, but that will define the way we live our lives. Is that something that you do study, or anything you have in mind that you feel strongly about?
Structurally, when I talk to people now, India has arrived. And, I have to recognize that India at the current point, possibly people will give higher valuation than they would have given in the pre-COVID period, because people don't want to invest in countries like China, Brazil. They can't invest in Russia. So that part we have to give a little bit more thought. Otherwise, technology change, how that is going to affect many things. I sometimes worry whether I'm in a position to understand that ramification fully. And I feel that all the Bangaloreans are possibly in a better position to understand this ramification. Whether they can understand the full ramification on a profit basis, I don't know. But at least they are better positioned to understand the trends better than us. And I think that we have to look at it a bit more closely than what I think a person at my age group also has to think a little bit more deeper. I may have more experience on markets, but do I have the thought process to think more deeply on the change which will happen due to AI and how various other things are going to shape different industries? I worry sometimes whether I'm underestimating the change. And I keep telling my younger colleagues in the company to think more, because they are more equipped to think of these kind of changes than maybe a person like me. And that is something I worry about. Look at the way Nvidia got re-rated. Imagine I was in India and I didn't buy Nvidia. Maybe I would be the last quartile fund manager in India. And that's something really worries me.
Yeah, I have seen stocks like InfoEdge in value funds. So I'm not sure, but whether that's the right thing. But anyways, so now coming to a small, more technical thing like Japan. Now we've got one single Japan fund which is there. Warren Buffett has taken a lot of exposure in that geography. Do you think that is a contra call because that's gone out of a 20, 25, 30-year-old zone?
It's been one of my biggest contra calls actually.
Oh, okay, wonderful.
And we run a fund called Global Advantage Fund of Fund. In that fund, in the published portfolio, you'll see a very big investment in the Japan fund of Nippon. Actually, it is a published portfolio. So I would say that clearly it's a big contra call. And Japan looks cheap on currency and markets both.
Okay. That was a personal question from my side. But just extending this question for a retail investor now, especially guys in the higher tax brackets, international funds have a highly inferior taxation compared to domestic funds, slab rate versus 10%. Do you think at this stage, the delta of taxation is worthwhile in terms of would the returns substitute for this, or shall it be taken more of a diversification that doesn't matter, some bit of returns here and there? I look at it more as a diversification. Like, how would you play this?
I'm not clear here actually. in the process of thinking on this issue.
Okay.
I'm personally not clear.
Okay, understand. And just as we come to the close of our session, few questions in terms of any expectations that you've got from equities, which you of course clearly define right now that India should get a higher price multiple post COVID, etc. But you feel surely that India over the next 3-5 years, give any ups and downs, should be one of the best performing asset classes globally.
Yeah, unless we do some self-goal, which I cannot predict.
Correct, of course.
Otherwise, that self-goal is there. Otherwise, see, India is in a better position in certain respects compared to other markets in the world. And having said that, the global macro, the way the interest rates in the Western world keep going up, all these are negatives. So it's more a relative story than an absolute story at this point of time.
And so what is your own, as two questions on your personal side, your own personal asset allocation right now? And how do you secure your own family in terms of taking care of nominations or wills? Just wanted to, for our...
Sure. So I have a special child, so I've created a trust for him.
Okay.
And created trustee and put a fund in as usual, considering that I'm so positive on asset allocation, I put the money in an asset allocation fund.
And which fund is this? Balanced Advantage Fund?
It's in a passive multi-asset fund of fund.
Okay.
And so I believe that that is...
Would you be comfortable naming this fund?
ICICI Passive Multi-Asset
ICICI Passive. Okay.
So given that, so I've created a trust.
Okay.
So that is how I have structured it. And so I believe that that is the way forward actually for me.
Okay, very interesting. And so thank you sir, for all the very valuable insights. Before I let you go, I want to know some bit of your personal life in terms of your best book, best fund manager. Whom do you yourself, if at all there is someone whom you look up to in terms of either peers or globally, best song, best movie, if that will help us understand a little bit more about your non-business side.
So best movie, I found Roja was one of the movies which really I liked.
And any song or same?
The song keep listening recently is Maru Artai.
Okay, nice.
Which is sung by a person called Sid Sriram.
Yeah.
And books, from a book's point of view, all my gurus are Howard Marks, James Pontier, Michael Mauboussin.
What do you do on weekends? And you actually spend a lot of time researching, etc. Like you said, a lot of people spend so much time, it becomes counterproductive. So, what do you do?
Actually, I do play some bridge. Then I listen to Carnatic music.
Okay.
Then I keep working, I think. And, managing 5.5 lakh crores of public money is a complex job. And you have a responsibility which you have to fulfill, and I keep worrying about it. Right. Otherwise, I always worry about my special child.
Right. Thank you so much. I think it was really wonderful to speak to you.
Thank you.
Spoken your mind out, and really privileged to have you on this show. Thank you, sir.